Insurance and find out what he's making of the market right now. Gautam, hi, great to have you on ET now. Good afternoon to you. Gautam, what do you make of the market right now? Well, of course, the overhangs on tariff, etc., remain. If you just look at the fund flows, and we were just dissecting that data, while it may look like, the FPI and FIs are exiting equity markets, but they are finding their way into, the IPO or the primary markets right now. What is it that you sense will make them come back into the secondary markets in the first place?
Yeah, thanks for having me here, Aisha. I think if you split out the India construct between domestic and non-domestic, I think it's just the non-domestic part, which is the worrisome part still, which is essentially FI flows and trade, especially the services trade and all that, and even the tariffs that have come in. But if you focus more on the domestic part, which if you remember where the problems for us started last year with a slowdown, some NPA formation taking place, I think we are at the fag end of that domestic slowdown cycle. Some of the data points which suggest that the credit costs are improving at the margin from our channel checks. Even there is some pickup in credit demand. And thirdly, most importantly, is the EPS downgrade cycle that we have been going through for more than 4-5 quarters now seems to be coming to an end, which would be more decisive this quarter and even more so in Q3 because that's where the GST impact in earnings will start coming through. And I was studying, this is actually quite widespread across domestic facing sectors and a couple of exporting sectors too. So that's really good news. That's really good news in the context that if you look at the market consolidation which has happened over the last 1 year, that has meant that large caps are trading not very expensive, right? And even mid caps, which are, by the way, seeing even earlier recovery in their earnings cycle, even mid caps are now not that very expensive that they were last year. So this is the construct that we are working with. We need some few triggers, and the most important trigger, as you rightly mentioned, will be some solution to be found on the external front, especially around the tariff-related discussions, which will happen sooner or later. I'm quite confident about that. So once that happens, I think the market really climbs this wall of worry and starts its upward movement again. So that is the construct that we are working with broadly. And I think two things need to be mentioned here. One is the very, very proactive and early, the rate cut and monetary easing cycle that the RBI started. That's really helpful. And secondly, of course, as I mentioned, the GST reform. So there were tax reforms earlier too, income tax reforms. So the complete focus, well coordinated focus by the both most important arms, which is the RBI and the fiscal part, the government, to give stimulus for demand, right? And this is what the country was probably lacking a bit of pickup of consumer demand in the mass scale. While we have seen the K-shaped recovery post-COVID, which meant that premium goods were selling well, but we needed a more mass scale pickup of consumption. I think the ingredients are in place for that to happen, and through H2 of FY26, we should start seeing that play out. And the third thing that really completes the picture here is inflation. When you look at inflation data in India today and compare it with the world, it's almost unbelievably low. Touch wood, let it remain like that. And in that context, the real rates are quite healthy. So that gives room for further rate cuts for India through the course of the year. And that will be more easy today because even the US Fed is looking to cut, right? So you can then have more leeway for cutting rates. So when that happens, what essentially happens is the cost of money and the inflation part, both are under control. That means that even with the lower nominal growth, which is what we are looking forward to, maybe a 10% handle kind of growth in nominal GDP and hence in nominal earnings for the corporate sector, that means your real returns, which is what matters for investors, is quite healthy. And that is a construct that we have to accept. Now, I think the conundrum has been that, people have seen 20% returns post-COVID for a few years and they have gotten used to it. So in that context, probably a 10% return or 12% return doesn't look that healthy. I agree. But in investing, absolute returns are very good. They look healthy, but what really matters is the real returns, and hence you never should forget the bond yields and the inflation picture. Versus that, if you look at the nominal returns that is prospectively on the table, it's quite healthy.
Right. Okay. So appreciate that very holistic roundup that you've given of your view when it comes to the market. But Gautam, you also said that large caps, after the kind of correction we've seen and the lull that we're seeing in the markets right now, large caps are looking more attractive in terms of valuation. So really two questions here. One, are you deploying any new cash into the market right now? And second, if yes, is it all going towards large caps or what is the mix looking like?
Okay. So essentially, my strategies are multi-cap and mid-cap, which is what I focus on. And yes, there was a more large-cap bias last year. But today, as I said, the earnings cycle recovery in mid-caps is a little bit faster. So mid-caps are getting their due attention for me, for sure. Large caps, while the valuation is more interesting, but we all know that, some of the most spectacular earnings growth stories which have come in India over the last 5, 6 years are all in mid caps, and that's where some of these companies are are very worthy of long term investing. And we have already seen some of them from IPO to Nifty inclusion, including some which is going to happen in this round in September end. So it's a spectacular journey for mid cap which has happened, and while obviously valuations have also started factoring that in, which is what was a bit of a worry last year. But not that they have become particularly cheap today, but today it's a much healthier environment to find bottom up ideas within the mid cap band.
All right, that's a bit of a allocation that you can have. But Gautam, the other sector that is getting hammered off late is actually the IT pack, because we were just talking about that. Yes, of course, the news flow around it seems to be exciting, but very little of that is getting factored into the market, and majority of these IT counters are at their 52-week low. What is your sense getting on the IT pack right now, given that the news flow is quite very bad, the stocks are getting hammered, but do you find any opportunity here?
Sure. So a couple of important things in IT is first, because of the whole US situation, the earnings growth outlook for them is a little bit muted versus what it was 3 quarters back. So there was a expected recovery which is getting delayed, which is fine, it's a cyclical thing. The other most important thing is AI and how it is going to impact IT. So we have been doing a lot of research on that, and a couple of conclusions which are very clear is that the employee intensity is going to come down, and secondly, especially at the lower end, and secondly, it's going to be a deflationary force from an overall budget perspective. But what people will also have to look is every time there has been a technology cycle in IT industry, and this has been going on for the last 30 years. We actually started from mainframe, we should not forget that, and we have come all the way to the world of AI today. Every time technology cycle shifts, the total addressable market in terms of the millions of lines of code that you write, the applications that you write expands. Right? We, as customers, also we experience that. Right? There was no Swiggy, there was no Zomato, let's say 10 years back. So the use cases for IT will expand. How dramatically it will expand is the question that remains to be answered. That is what will determine the course for this industry going forward. Yes, the companies have to be on the ball. They have to get their act together. They have to keep themselves relevant in the world of AI. That is the biggest thing we look for when we are evaluating IT companies today. There's no big hurry today, honestly, because valuations have not really corrected that much, especially when you compare to the US listed IT services companies, Accenture and Cognizant. And for the Indian IT services companies, they're still at a bit of an expensive valuation, you can say, relatively speaking. Secondly, it's not like a very here and now recovery, right? That's going to happen in IT. It is something that we are doing a lot of work on. We have positions there because in IT also we thankfully have